Hello everyone and welcome to our next NAP. NAP stands for Nonprofit Auditor Points and I'm Irina Oryshkova, your nonprofit auditor. I designed these NAPs to help nonprofit community to understand accounting rule specifically related to GAAP better and have a good financial statements and understanding of accounting principles. And we continue the series regarding revenue recognition. In the past episodes, we talked about earned revenue or exchange transactions where the donor and where the parties exchange the services and versus with the cash, and where the second type of revenue it's contributions that called non-reciprocal transactions, and there is no exchange in value. Those are recognized under 958. And we were talking about that contributions, and sometimes we refer to them as gifts, promises, pledges, bequests, donations, they all under one umbrella contributions, recognized as revenue when they're unconditionally promised. And we talked about what constitutes the condition and why it is very important to differentiate between condition and restriction. And then conditions precludes revenue recognition. Restrictions do not preclude revenue recognition. They simply tell us how funds can be used. Today, we're going to focus on something often misunderstood by a lot of board members who are not really involved in or understand accounting around nonprofits. And that's specifically related to multi-year grants. Because once promise is unconditional, the accounting rules require us to record the full amount as revenue right away. And the promise can be promised 2 years, for 3 years, for 4 years, 5 or 10, regardless how long, for how many years donor promises to give us funds, to give funds to nonprofit. As soon as that promise is unconditional, the full amount needs to be recognized as revenue right away. And that's kind of counterintuitive because promise happens in the year number 1, but the cash will be arriving in the year 2, 3, 4, 5, 6, so and so forth, depending how many year promises for. So we will see cash is coming in different periods, but revenue will be recognized in full amount in the year 1. Let's start with a specific example. Suppose a foundation sends a nonprofit a signed award letter that provides a commitment to give $300,000 over a 3-year period. The agreement does not have any performance barriers that ties to entitlement. So nonprofit is entitled to this $300,000 that will be paid during a period of 3 years. There is no right of return, so the funds are committed. That means the promise is unconditional. Now, here's the key question. When do we recognize revenue? Under GAAP, which is General Accepted Accounting Principles, that based on accrual method of accounting, we recognize it immediately. As soon as nonprofit receives the award letter, we record debit receivables for $300,000 and credit revenue for $300,000. So we increase receivables and we increase revenue based on that promise. That's where a lot of confusion comes, because some board members might say, but we are only receiving $100,000 cash per year. Why we're recognizing the full $300,000 now? Because accounting follows the right to receive, not the cash flow. It means that as soon as award letter was received, the right to receive funds already transferred to nonprofit. The fact that nonprofit will be getting $100,000 a year in cash is just how it will be paid. But the right transferred as soon as award letter was provided. So this does not mean that the organization suddenly has $300,000 in cash. So even though we recognize revenue for $300,000, there's still not going to be cash. It means that the organization just have a right to receive this money over time. And that right has a value, $300,000. Also, specifically for large amounts of revenue, and especially the longer period, if we're talking about 5-year grant, 6 years, 7, and so forth, we need to remember that value of even $1 that you will get today versus $1 that you will get 5 years later, it's different because of the inflation. Typically, that buying power of that $1 is different. Therefore, rules require to recognize multi-year grant, and we need to apply them based on a present value. So if the payments will be received over multiple years, and the amount is significant and period is long, and I will say 3 years and longer, GAAP requires the receivables to be recorded at present value. That means we need to apply discount rate for discount future payment. Why? Again, because the money received 3 years from now do not have the same worth as the money received today, because most likely they have less buying power due to inflation and so forth. This is a basic principle financial concept. So in our example, when we were talking about $300,000 that will be paid over a period of 3 years, we may need to calculate present value of those future payments using appropriate discount rate, and apply it just in record donation at discounted value. So it's going to be less than $300,000 by the discount rate that we're going to use. So multi-year unconditional pledges, we need to remember that multi-year unconditional pledges needs to be recognized as revenue right away, as soon as they promised, as soon as the nonprofit is aware, as soon as unconditional promise was made. And if the amount is material, then the discount rate needs to be applied, and we need to record it at present value. Now, let me explain why this matter beyond accounting terms, why it's not just accounting issue. Recognizing multi-year pledges or contributions upfront can significantly impact your financial statements. You may show a large surplus in a year when it was recorded as revenue in the first year. The following years, you may show much lower revenue, but you will show more expenses because you're actually spending down that grant. And boards sometimes, or even readers to financial statements, maybe even donors, can misinterpret this, and they see that the first year was very strong performance, and it's eventually performance became weaker and weaker. In reality, that's not a correct assessment, because in order to read financial statements properly, we need to understand accounting rules. So when the grant was given to do the work for the next 3 years, revenue is recognized in year 1, but work will be done actually year 2 and 3. So there are going to be expenses in year 2 and 3, but no revenue. Therefore, it might affect even liquidity, it might affect planning, it might affect fundraising, your narrative when you're sending applications to the funders. So how you explain your nonprofit performance, what is your operational cycle, donation cycle, all of that really matter. So to understand by fundraisers, by board members in your finance team. So from the audit perspective, multi-year pledges are very important area for the auditors to concentrate, because the auditors will look at the grant agreements and the timing of revenue recognition, discount rates, and collectibility of the pledges. There are possibility that some multi-year grants might not be collectible because of the change in financial situation of the donors or for other reasons. So if there is an issue of collectability might arise, we might need to record allowance for uncollectible pledges or even bad debt expense for uncollectible multi-year grants. So therefore, we need to remember when we're analyzing multi-year grants or any grants, we need to understand if the promise is really unconditional. And if it's unconditional, we recognize the full value immediately. If it's paid over time and payment schedule does not have effect on revenue recognition, it has effect only on the cash. Therefore, we will have record receivables and we will decrease receivables over time as we receive the cash. And if it's really long-term pledges, 3 years and longer, and material, we will need to calculate present value of the donation recorded at present value. So just to give final thoughts, if your nonprofit receive a signed unconditional multi-year award, you should recognize the full amount right away. You do not wait to recognize revenue each year as cash comes in. That's not GAAP. You need to record receivables upfront, and you need to calculate discount rate if the amount is material to overall financial statements. And make sure that the board understands what's driving the change in reported revenue, why there's distortion between 1 year and another year, where revenue here and expenses in the future years. And your funders and donors also needs to understand why that your operational cycle may be affected by multi-year donation. So cash flow is very important to you, and cash flow not necessarily strictly related to the revenue amount that's shown on financials. In the next episode, we're going to shift to next major concept, which is restricted versus unrestricted contributions, or proper terms is contributions with donor restrictions and without donor restrictions. Again, to remind you, restrictions do not affect revenue recognition. It's just affecting classification. Where is it recorded? But revenue recognition is not affected. As long as it's unconditional promise, whether with donors restrictions or without donor restrictions, it's all recorded as a revenue right away. Thank you so much. Looking forward to see you for the next snap. Thank you and have a wonderful day.